Friends, thank you for being here today. What if I told you that the second largest economy in the Eurozone is currently being treated by bond markets like a subprime borrower? What if I told you that France, a G7 nation, a nuclear power, the cornerstone of the European project alongside Germany, is now paying interest rates on its debt that make it look less like a core member and more like the crisis cases we saw in Spain and Portugal a decade ago? This isn't speculation. This is happening right now in real time, and the numbers are staggering beyond comprehension. We're talking about 100 billion euros. That's the projected annual cost just to service French debt by 2029. To put that in perspective, that's more than France will spend on its entire defense budget, more than education. This is a mathematical black hole that is swallowing the tax revenue of the French Republic whole. And here's the number that should make every investor, every euro holder, every person watching the global financial system sit up and pay attention: 88 basis points. The spread between French government bonds, what they call OATs, and German bunds just hit 0.88%. That's a 12-year high. In the quiet, bloodless language of the bond market, this isn't a fluctuation. This is a scream of panic. This is the market saying that French debt carries risk, real, tangible default risk, on a level we haven't seen since the darkest days of the Eurozone debt crisis. This is not a market correction. This is not a temporary adjustment. This is a structural fault line opening up in the foundation of the European financial architecture. And what I'm about to show you is why this represents a singular inevitability, a mathematical endgame that cannot be avoided, only prepared for. Because here's what makes this truly terrifying. France is caught in what I call a political doom loop. The deficit currently stands at 5.8% of GDP, nearly double the European Union's legal limit of 3%. To fix that deficit requires austerity. It requires spending cuts. Deep, painful, politically toxic spending cuts. But the French parliament is fractured into three hostile blocs: the left, the center, and the far right. And any government that attempts those cuts will be instantly toppled. The math requires cuts. The politics forbids them. And when those two forces collide, when the mathematical reality meets the political impossibility, there is only one remaining door: default, or what the system prefers to call soft default, through inflation. The slow, silent theft of purchasing power that allows governments to pay back debt in currency worth less than what they borrowed. The trigger for this has already been pulled. The liquidity tide is going out, and we are about to find out who is swimming naked. Now, to understand how we arrived at this moment, we cannot start with today's headlines. We must go back to the origin, to the architectural decisions that created this system and embedded within it the seeds of its own destruction. October 1962. That was the last time a French government was toppled by a vote of no confidence. Let that sink in for a moment. For 62 years, the French Fifth Republic was designed to be a tank, stable, executive-led, immune to the parliamentary chaos that had paralyzed the Fourth Republic in the decades before. Charles de Gaulle himself designed this system specifically to prevent the kind of political instability that had made France ungovernable. For 6 decades, it worked. Through oil shocks, through currency crises, through the transition to the euro, through the 2008 financial crisis, the Fifth Republic stood firm. The executive had power. The government could govern. France was stable. That stability just shattered. On December 4th, 2024, the National Assembly passed a motion of no confidence with 331 votes, well above the 288 needed, effectively firing Prime Minister Michel Barnier. This wasn't a close call. This was a decisive rejection. and it left France with no government, no budget, and no clear path forward. The tank is broken. We have returned to the instability of the Fourth Republic, but with one critical difference. The Fourth Republic didn't have 3.2 trillion euros in debt hanging over its head. This is where we need to understand the mechanism, the black box that few people outside of French politics truly comprehend. It's called Article 49.3, and it's essentially the nuclear option of French parliamentary procedure. Think of it like this. Imagine you have a credit card, and you can force the bank to increase your limit without their permission. That's essentially what Article 49.3 allows the French Prime Minister to do with legislation. The PM can pass a budget or any law without a parliamentary vote. It's a way to ram through unpopular measures when the government knows it doesn't have the votes. But here's the twist. Here's the trapdoor built into the system. The opposition gets to play what you might call a trap card. They can trigger a motion of censure, a no confidence vote, and if that motion passes, the law is void and the government is fired. The gun has a hair trigger and it points both ways. Michel Barnier pulled that trigger. He used Article 49.3 to force through a budget that included 60 billion euros in spending cuts and tax increases. Painful measures designed to bring that 5.8% deficit back toward the EU's 3% limit. The opposition, both the far left and the far right, in a rare moment of agreement, pulled their own trigger in response. The motion passed, the government fell, the budget died, and now France sits in limbo, governed by what they call a caretaker government, a government with no mandate, no budget, and no power to fix the crisis that is accelerating around them. But here's what I need you to understand. Everyone is watching the French politicians. Everyone is focused on the drama in the National Assembly, on Marine Le Pen and Jean-Luc Mélenchon and their political calculations. That's the theater. That's the distraction. The real executioner is in Frankfurt. It's in Berlin. It's in the bond market. The European Central Bank and the German government have been the backstop, the implicit guarantee that has kept the Eurozone together through every crisis since 2010. When Greece was on the brink, Germany wrote checks. When Italy's yields spiked, the ECB intervened. The message was clear: we will not let a core member fail. But here's the secret that changes everything. The factor that makes this crisis different from every other European crisis we've seen. Germany is in a recession. German GDP growth is at zero. The German economy, the engine that has powered European bailouts, the checkbook that has kept the system solvent, is stalling. Germany cannot afford to bail out France. The safety net has a hole in it. This leads us to the system's most crucial secret, which we will explore in detail, but first we need to see how the contagion is already spreading, how the canaries in the coal mine are already dying. The bond market doesn't wait for official announcements. It doesn't wait for press conferences or policy statements. The bond market sniffs out weakness and reprices risk in real time. And right now it is repricing France from safe assets to return-free risk. That 88 basis points spread between French OATs and German Bunds, let me explain why this matters, because if you're not a bond trader, you might think 0.88% doesn't sound like much. But in the world of sovereign debt, especially among supposedly equivalent Eurozone members, this is an earthquake. Under normal circumstances, under the illusion of European unity, French and German bonds should trade at roughly similar yields. They're both in the euro. They both have large liquid bond markets. They're both core members. The spread between them should be minimal, maybe 10 or 20 basis points at most, reflecting minor differences in liquidity or technical factors. 88 basis points means the market is demanding danger money. It means investors are saying, We will hold French debt, but we need to be compensated for the risk that France might not be able to pay us back, or might pay us back in currency that's been debased through inflation. This is the bond vigilantes awakening. This is the invisible force that toppled governments in Italy and Greece and Spain during the last European debt crisis. And they are now turning their sights on France. Now, let me show you the canaries that are already dying in this coal mine, because the evidence of systemic rot is not theoretical. It is tangible, specific, and accelerating. The first canary is right there in the spread itself, but we need to understand what it reveals. When bond yields rise, when that spread widens, bond prices fall. This is the iron law of fixed income. Yield and price move in opposite directions. And who holds the most French government debt? French banks. BNP Paribas, Société Générale, Crédit Agricole. These banking giants have loaded their balance sheets with OATs, treating them as safe, liquid assets that satisfy their regulatory capital requirements. But as those bond prices fall, the value of those assets evaporates. The bank's balance sheets erode in real time. Look at the stock prices of these institutions over the past month. The volatility tells you everything you need to know. The market understands what's happening. This is the sovereign doom loop, and it works like this. Banks hold massive amounts of government debt. When the government gets in trouble, those bonds lose value. When banks get in trouble holding those bonds, the government has to bail them out. But the government can't bail out the banks because the government is already drowning in debt. The snake is eating its own tail, and each bite makes the next one inevitable. The second canary comes from the rating agencies. Now, I know what you're thinking. The rating agencies, the same ones that stamped AAA ratings on subprime mortgage securities in 2007. Yes, those rating agencies. They're late to every crisis, but when they finally move, they move in herds, and the consequences are mechanical and brutal. Fitch has already downgraded France to A+ with a negative outlook. That's 2 notches below the top AAA rating. Moody's is watching closely, and the market knows another downgrade is coming. Here's why this matters beyond just the symbolic embarrassment. Pension funds, insurance companies, and institutional investors often have mandates, legal requirements, that say they can only hold investment-grade debt above a certain rating threshold. When France gets downgraded below that threshold, these institutions don't have a choice. They must sell. It's not a decision. It's a regulatory requirement. Imagine hundreds of billions of euros in French debt hitting the market simultaneously as these forced sellers liquidate their positions. The technical term for this is a liquidity cascade. The common term is a fire sale. Prices collapse. Yields spike even higher. The doom loop accelerates. The third canary is the most revealing, and it's one that requires us to look beyond France itself to understand the contagion risk. French banks don't just hold French debt. They are deeply embedded in the entire European financial architecture. They have exposure to Italian debt, Spanish debt, and corporate bonds across the continent. They provide credit lines to businesses from Lisbon to Warsaw. When these banks come under pressure, when their capital buffers shrink because their sovereign bond holdings are losing value, they pull back. They reduce lending. They hoard liquidity. And that credit contraction ripples through the real economy like a seismic wave. This is how a sovereign debt crisis in one country becomes a continental crisis. This is how the sick man of Europe infects the entire hospital. Let me paint you the picture of the trap France now finds itself in, because this is where the mathematical inevitability becomes crystal clear. This is the no-escape encirclement. If they cut spending, if they implement the austerity measures needed to bring the deficit back to 3%, the streets explode. We've seen this movie before. The yellow vests brought Paris to a standstill over a fuel tax. Imagine what happens when the government announces cuts to pensions, to healthcare, to public sector wages. The social fabric tears. The government that attempts it gets toppled in weeks, if not days. The current parliamentary arithmetic makes this a certainty, not a possibility. If they try to print money, if they pressure the European Central Bank to simply monetize the debt through quantitative easing, Germany says 9. The Bundesbank, the guardian of German monetary orthodoxy, the institution that still carries the trauma of Weimar hyperinflation in its institutional DNA, will not allow the ECB to become a pure debt monetization machine. And without German acquiescence, the ECB's hands are tied. The printing press is not an option. If they do nothing, if they simply muddle through with a caretaker government and hope the crisis passes, the bond vigilantes drive yields higher, 4%, 5%, and at those levels, the math becomes absolutely catastrophic. Remember that 100 billion euros in annual debt servicing costs I mentioned earlier? That assumes yields stay roughly where they are now. If yields spike to Greek crisis levels, that number doubles. It becomes 200 billion euros, more than the entire French defense and education budgets combined. At that point, the French state is not governing. It is simply servicing debt. Everything else becomes an afterthought. This is what I mean by a doom loop. Every exit is blocked. Every path leads to the same destination. France is a car speeding toward a wall, and the passengers in Parliament are fighting over the steering wheel while the bond market presses the accelerator. And here's where we need to zoom out and see the convergence, the trifecta of forces that are hitting simultaneously, because this isn't just a French crisis. This is the moment when the fragility of the entire European project gets stress tested and the cracks are already visible. Force number 1, political paralysis. The hung parliament means no budget can legally pass through normal procedures. Article 49.3 just blew up in spectacular fashion. There is no mechanism for the French government to implement the fiscal discipline the bond market is demanding. The political system and the economic reality are on a collision course, and there is no referee to stop the crash. Force number 2, the debt wall. France must roll over, must refinance hundreds of billions of euros in maturing debt throughout 2025. Every time a bond comes due, they have to go back to the market and issue new bonds to pay off the old ones. This is standard procedure for every government. But here's the problem. They now have to do this at significantly higher interest rates than when the original bonds were issued. The cost of maintaining the same amount of debt just went up by tens of billions of euros annually, and the bond vigilantes know this. They know France is a forced buyer, or rather a forced borrower. And when you're forced to borrow, the market extracts a premium. It's financial predation, and it's already begun. Force number 3. And this is the force that changes everything, the factor that makes this crisis existentially different from every other European crisis we've weathered: German weakness. For the past 15 years, every time a European country got into trouble, the implicit assumption was that Germany would open its checkbook. Germany bailed out Greece. Germany backstopped the European stability mechanism. Germany provided the political will and the fiscal capacity to hold the Eurozone together. But Germany's economy is now stagnating, 0% growth. The German industrial model, export-led, manufacturing-heavy, dependent on cheap Russian energy that no longer exists, is broken. The Czechs are not coming. The cavalry is not riding to the rescue. France is looking to Berlin for a bailout, and Berlin is looking at its own budget crisis, its own political paralysis, its own recession, and saying, "We cannot help you." This is the convergence. This is the trifecta. And when these three forces hit simultaneously, political paralysis, a debt rollover crisis, and the absence of a credible backstop, the system doesn't bend, it breaks. Now, I need to talk to you about something that has nothing to do with bonds or deficits or parliamentary procedures. I need to talk to you about your mind, because the greatest threat in a crisis like this isn't the crisis itself, it's your own psychology, your own hardwired tendency to believe that tomorrow will look like yesterday. It's called normalcy bias, and human beings are drowning in it. Your brain is designed to assume continuity. It's an evolutionary adaptation that usually serves you well. If the sun rose yesterday, it will probably rise tomorrow. If your paycheck cleared last month, it will probably clear next month. This assumption of stability is what allows you to function without constant paranoia. But in moments of systemic transition, in moments when the scaffolding of the financial system is crumbling, normalcy bias becomes a trap. It's the reason people didn't evacuate New Orleans before Katrina. It's the reason investors didn't sell in October 1929 or September 2008 until it was too late. The mind cannot process the idea that the system itself might fail, so it rationalizes, it justifies, it assumes that someone somewhere will step in and fix things. Let me tell you what normalcy bias sounds like right now. France is too big to fail. The EU won't let it happen. They'll figure something out. They always do. And that assumption, that comfortable, reassuring assumption, is the most dangerous position you can hold right now. Because here's what history actually teaches us. Every empire, every currency, every financial system that has ever existed believed it was too big to fail right up until the moment it failed. The Roman denarius was debased slowly over centuries until it was worthless. The British pound sterling was the global reserve currency until it wasn't. The assumption of permanence is always strongest right before the collapse. And there's another psychological trap I need to warn you about, one that's even more insidious because it operates at the level of your daily experience. It's called the money illusion. This is the cognitive error where you confuse nominal wealth, the numbers in your account, with real purchasing power. You become a millionaire on paper, but you're poorer at the grocery store. Your salary goes up by 5%, but prices go up by 8%, and somehow you feel like you should be grateful for the raise. The money illusion is how governments default without admitting default. They don't announce bankruptcy. They don't stand at a podium and say, we cannot pay our debts. Instead, they inflate, they print, they debase the currency slowly enough that each individual price increase seems like an isolated event rather than a systemic theft of purchasing power. And this is exactly what France, and by extension the entire Eurozone, is being set up for. Because when the political system cannot impose austerity, and when the bond market cannot be appeased, the only remaining release valve is inflation. The European Central Bank will eventually cave. They will restart quantitative easing. They will buy French bonds to keep yields from spiking into the stratosphere. They will do this because the alternative, allowing France to default explicitly, would detonate the euro itself. But understand what this means. Every euro you hold, every euro-denominated bond, every claim on European assets becomes a claim on a currency that is being systematically debased. You're not going to see a headline that says euro collapses. You're going to see your rent go up, your food costs increase, your energy bills spike, and the talking heads on television will blame corporate greed or supply chains or geopolitics, anything except the reality that the currency itself is being hollowed out from within. This brings us to the fundamental question, the binary choice that every person watching this needs to answer for themselves. Do you own assets, or do you own claims on assets? Let me explain the difference, because this distinction is about to become the defining line between those who preserve wealth through this transition and those who watch it evaporate. A claim on an asset is a promise. It's a stock certificate that says you own a piece of a company. It's a bond that says a government will pay you back. It's a number in a bank account that says the bank owes you money. These are all second-order abstractions. They are paper representations of value, and they depend entirely on the continued functioning and solvency of the institutions that issued them. An asset is the thing itself: land, commodities, precious metals. These exist independent of any government's promise or any bank's solvency. They have no counterparty risk. If the French government collapses, your French government bonds become worthless paper. If the euro collapses, your euro bank deposits lose purchasing power catastrophically. But if you own an ounce of gold, you still own an ounce of gold. The physical reality doesn't change based on political outcomes. Now I can already hear the objections forming in your mind. Gold doesn't pay dividends. Gold doesn't generate cash flow. Gold just sits there. And you're right. Gold is not an investment in the traditional sense. It's not designed to make you rich. It's designed to keep you from becoming poor. It's insurance against exactly the kind of systemic crisis we're witnessing unfold in France right now. Think of it this way. Gold is stepping out of the line of fire. When governments are in a debt spiral, when central banks are trapped between deflation and inflation with no good options, when the political system is paralyzed and the bond markets are in revolt, you don't want to be holding the assets that depend on those systems continuing to function smoothly. You want to be holding the assets that exist outside the system entirely. Silver carries the same properties, with an additional industrial demand component that makes it potentially more volatile, but also more responsive to economic recovery scenarios. But the principle is the same: physical assets with no counterparty risk. And let's be clear about what we're hedging against here, because this isn't about predicting the end of civilization or some Mad Max scenario. This is about recognizing that we are in the late stages of a debt supercycle, and the options for resolving that debt are extremely limited. Option 1, austerity. Cut spending, raise taxes, pay down the debt honestly. Politically impossible in France, politically suicidal almost everywhere else. This option is off the table. Option 2, growth. Grow the economy fast enough that the debt becomes manageable as a percentage of GDP. With aging populations, productivity stagnation, and the global economy teetering on recession, this is wishful thinking, not a strategy. Option 3, default. Admit you cannot pay and restructure the debt. This triggers immediate contagion as every other heavily indebted country gets repriced. The financial system seizes up. This is the option everyone wants to avoid. Option 4, inflation. Print money, debase the currency, and pay back the debt in currency worth less than when you borrowed it. This is the path of least resistance. This is the politically expedient choice. This is what's coming. And when inflation comes, real inflation, not the carefully massaged CPI numbers that exclude everything you actually buy, the distinction between owning assets and owning claims on assets becomes existential. Let me give you a concrete example of how this plays out, because we've seen this movie before. Weimar Germany in the 1920s. The government faced massive war reparations and couldn't impose the austerity needed to pay them through taxation, so they printed. And as they printed, people who held German marks watched their savings evaporate. A lifetime of work gone in months. But people who owned physical assets, farmland, factories, gold, preserved their wealth. The number of marks it took to buy those assets went up astronomically, but the assets themselves retained value. A farm that could feed 100 people before the hyperinflation could still feed 100 people after. The productive capacity didn't change. Only the nominal price in the debased currency changed. Now, I'm not predicting Weimar-style hyperinflation for the euro. The mechanisms are different. The institutional frameworks are more robust, and the European Central Bank has more tools at its disposal than the Reichsbank did. But the principle remains. When the currency is being debased, whether rapidly through hyperinflation or slowly through persistent above-target inflation, holding the currency itself is a losing position. And here's the part that should terrify every euro holder. You're not holding a currency backed by a single government's taxing power. You're holding a currency backed by the collective solvency of 20 different governments, many of which are in various stages of fiscal crisis. The euro is an experiment in monetary union without fiscal union. It's a currency without a country. And when France, the second largest economy in that union, starts to crack, the entire foundation becomes suspect. The bond market understands this. That 88 basis point spread isn't just about French fiscal policy. It's about the viability of the European project itself. Because if France can't govern itself, if France can't impose fiscal discipline, if France becomes a permanent ward of the ECB requiring constant monetary life support, what does that say about the euro? It says the euro is not a store of value. It's a political construct held together by institutional inertia and the fear of what would happen if it fell apart. And increasingly, the bond market is saying, we want to be compensated for that political risk. Let me show you how the contagion spreads from here, because France is not an isolated case. It's a tremor before the earthquake. Italy has a debt-to-GDP ratio of over 140%. Spain is dealing with separatist movements and its own political fragmentation. Portugal's economy is too small to matter in the grand scheme, but its debt levels are concerning. And Germany, the supposed anchor of stability, is facing a competitiveness crisis as its industrial base hemorrhages to lower-cost regions and its energy costs remain structurally higher post-Russia. When France wobbles, investors don't just reprice French risk, they reprice European risk. The spreads widen not just for OATs, but for BTPs, Italian bonds, for bonos, Spanish bonds, for every piece of sovereign debt in the periphery. The entire yield curve shifts upward. The cost of debt service across the continent increases simultaneously. And here's the doom loop at the continental level. As debt service costs rise, deficits widen. As deficits widen, more debt must be issued. As more debt is issued, yields rise further. The snake accelerates its consumption of its own tail. The European Central Bank will intervene. They have to. The transmission protection instrument, the tool they created specifically to prevent this kind of sovereign debt crisis, will be activated. The ECB will start buying French bonds, Italian bonds, any European sovereign debt that's under pressure. But understand what this intervention represents. It's not a solution. It's a delay mechanism. It's kicking the can down the road by having the central bank become the buyer of last resort for government debt that the private market doesn't want at current prices. It's the central bank saying, we will create money to buy your bonds because no one else will. This is debt monetization with extra steps. This is the soft default I mentioned at the beginning, the inflation tax that allows governments to service nominal debts while destroying real purchasing power. And this is where we need to talk about the safe asset illusion, because it cuts to the heart of why this moment is so dangerous for unprepared investors. You hold euros because you think they are backed by Europe. You think there's some institutional strength, some collective guarantee that ensures your deposits maintain value. But peel back the layers and ask yourself, what actually backs the euro? It's not gold. The gold standard ended decades ago. It's not a basket of commodities. It's not pegged to anything tangible. The euro is backed by the taxing power and the productive capacity of its member states. It's backed by the willingness of European governments to impose fiscal discipline and maintain the currency's value. But if France, a core member, a nuclear power, the second largest economy, cannot govern itself, cannot pass a budget, cannot impose fiscal discipline, then what is the euro actually backed by? It's backed by the willingness of the ECB to print more of it. It's backed by a printing press and a hope that inflation stays contained. That's not a hard asset. That's a soft promise that's getting softer by the day. Now, let me address the counter argument that I know is forming, because intelligent people will push back on the gold thesis. They'll say, but gold has been in a consolidation pattern. The dollar has been strong. Why would I move into gold now when the charts don't show imminent breakout? And here's my answer. You don't buy insurance after your house is on fire. You buy it when the fire is still containable, when most people are still assuming everything will be fine. The bond market is already moving. That 88 basis point spread didn't appear overnight. It's been widening for weeks as smart money repositioned. The rating agencies are already downgrading. The political crisis is already here. The caretaker government is already in place. The fire has started. Most people just don't smell the smoke yet because normalcy bias is powerful, and the mainstream financial media is still talking about buying the dip and temporary political uncertainty. Let me tell you what's really happening beneath the surface, in the quiet rooms where central bankers and finance ministers are having conversations they don't want made public. They know the debt is unsustainable. They've known it for years. The Bank for International Settlements, the central bank for central banks, has been publishing reports about the global debt burden and the impossibility of paying it back through traditional means. These aren't conspiracy theories. These are official publications from the most conservative financial institutions in the world. The plan, and there is a plan, even if it's never explicitly stated, is inflation. Persistent above target inflation that slowly erodes the real value of the debt while allowing governments to claim they're still making nominal payments. It's a soft default dressed up as monetary policy. But here's the problem with that plan. Inflation is not a precision instrument. Once you open that door, once you signal that the central bank is willing to monetize debt to prevent sovereign defaults, inflation expectations become unanchored. Markets start pricing in perpetual debasement. Wage demands increase. Price increases become self-fulfilling. What was supposed to be a controlled burn becomes a wildfire, and France is the accelerant, because France is not Greece. France is not a small peripheral economy that can be bailed out without systemic risk. France is 15% of Eurozone GDP. French banks are embedded throughout the European financial system. If France goes into a full-blown debt crisis requiring permanent ECB intervention, the message to markets is clear. The ECB will print without limit to prevent any core member from defaulting. That's the moment the euro's credibility as a store of value evaporates entirely. So here's the binary choice again, stated as clearly as I can. Do you want to hold a currency that is backed by governments in fiscal crisis and a central bank that will print to prevent those crises from becoming explicit defaults? Or do you want to hold assets that exist independent of those political decisions? Paper or metal, claims or things, promises or reality? This is not about getting rich. This is about not becoming poor. This is about understanding that we are in a transition phase from the illusion of paper wealth to the reality of hard assets. And those transitions are historically brutal for people who don't see them coming. History favors the prepared, and the window for preparation is closing. The bond market is already repricing European risk. The political paralysis is already here. The debt rollover wall is already looming. The German backstop is already exhausted. The dominoes are lined up. The first one, France, is already wobbling. And when it falls, the question isn't whether the others will follow. The question is whether you've positioned yourself outside the path of the cascade. Friends, I'm not telling you this to create panic. I'm telling you this because the evidence is overwhelming, the mathematics is undeniable, and the options for resolving this crisis are extremely limited. The system is showing you what's coming. The bond market is screaming it. The political chaos is demonstrating it. The only question is whether you're listening. Gold and silver are not speculative bets. They are insurance policies against sovereign insolvency and currency debasement. They are ways to opt out of a system that is visibly breaking down. They are hard assets in an age where paper claims are about to be tested in ways they haven't been tested since the 1970s, or possibly since the 1930s. This is not financial advice. I'm not a financial advisor. Every person must make their own decisions about how to position their wealth. But I am telling you, as someone who has studied these systems, who has watched these cycles repeat throughout history, that the warning signs are all flashing red simultaneously. France's government has fallen, the bond market is in revolt, the ECB is trapped between impossible choices, and the currency you're holding is backed by institutions that are proving in real time that they cannot impose the discipline necessary to maintain its value. The transition from illusion to reality is beginning. The question is whether you'll recognize it while there's still time to act, or whether you'll wait until the transition is complete and the repricing has already happened. Thank you for being here today, friends. Thank you for being willing to look at uncomfortable truths while there's still time to prepare. The next few months will tell us whether Europe can somehow thread the needle and restore confidence, or whether we're witnessing the beginning of the Eurozone's Lehman moment, the crisis that breaks the system.